I have earmarked maybe an hour and a half for this presentation, but I don't think that it will necessarily take that long. All right, this is a disclosure thing, so please don't take any advice from me unless we're actually talking about your situation. I took a look, I needed to update that to 2025. The last one I had that up there is to 2024. Okay, real quick, for those of you that want to know what's coming up soon for us, we've got a couple of things. This QR code will lead you to our events page. And so if you ever want to navigate and see what's coming up, but I did want to highlight two things that are coming up. One, we have a set of educational workshops that are being given in April and May. One of them is in Princeton Theological Seminary, which is right in the heart of where Princeton proper is. The other one's in Raritan Valley Community College, so up by Branchburg area. If you want to come and re-emphasize, cement your education around retirement planning, you are welcome to register and come to that. If you have somebody that you'd like to introduce or you want to join with you, you can make a joint trip there. We'll welcome both of you in there. Just so you're aware, these are recruiting activities. At the end of them, I ask people to come in for an appointment. You don't have to do anything, but if you want to whisper like in the background, he's fantastic, you should make an appointment. I've heard so much about him, you're welcome to do that. The other thing is the date for our spring shredding event. So this is actually going to be a Friday this year instead of a Saturday, and it's May 16th, 10 to 2 p.m. So if you've got any paper that you want shredded, hard drives, or anything that looks like a computer, be on the lookout for the invitation, and then the only thing that we do is kind of ask you to sign up for a slot so we don't have a big line of cars going in, but the team will be available. You'll drive in, open your trunk, we'll take all the boxes out, then you can park across the street, come in, enjoy our food truck, hang out with us for a little bit. Hopefully we've got great weather, all right? But this little QR code is for the events page, and so everything that we're doing is up on that. Any questions on those before they come up? That educational event's about 2 hours when it happens or so. Go through tax planning. We do a little bit of estate planning, not too much, income and investment planning, and so it's a good kind of review. Some of you have seen that before. Some of you will have seen that for the first time. Here are the 5 key risks and what I'm going to call also opportunities, plus the solutions that we're going to go through today. One's going to cover market volatility and policy-driven uncertainty. The next one's going to talk about inflation, rising cost of living. The next one's going to be tax uncertainty and legislative changes. The fourth will be effects to Social Security and Medicare. Come on in. And then the last one is going to be longevity and long-term care risks. Now, before I get started, a warning or a promise. I am not going to be discussing any politics today. We are not going to be engaging in any conjecture one way or the other. All right? If you're in love with what's happening, good for you. If you hate what's happening, good for you. I'm just going to remain Switzerland off of this and tell you what the effect is to planning so that you can kind of keep your head screwed on straight and think about it the way that I think about it, who's caring for you. So let's go ahead and start about market volatility and policy-driven uncertainty. So there's 2 risks here, and some of them have been really present in the news, right? So the first one has been effects to kind of geopolitical tensions, deregulation. We've got a lot of news coming out that are big sweeping changes to what were the status quo. And as a result, what we're watching is markets react to that in a way that has been more volatile than what would be traditional news that have been coming out. And by the way, not all in one direction or the other. We've seen downward volatility. We've seen rebounds off of it. It's just one of these things where the swings seem to be going greater in each direction. The next thing is that the policies that are being offered introduce some instability around things that are going to drive inflation, okay, and additional spending or deficit spending. So we're currently under a deficit. We're currently with that deficit growing. And despite the changes that are coming up or being proposed, there's nothing being shared in the news that suggests that any of these changes are going to quickly correct that situation. And so from the perspective of thinking about what increased debt is going to look like and or what market volatility looks like, we've got three things that we're considering in terms of solutions or additional suggestions for what to do. The first is we're very big proponents of what are bucketing strategies for the use of your money. And so these buckets are going to probably easiest to be understood as short, mid, and long-term buckets. You might think about it as a safety, income, or growth. One of these buckets are in each of the where your dollars are. And so to the extent that you have a safety bucket, that safety bucket is going to be the thing that keeps you sleeping well at night, make sure that you have enough liquidity to handle any of what life might need in a second. So if you need a change to your car or if there's something that goes wrong with your house, this is going to be the easiest money to draw from, and it's going to be the safest money that's available. So keeping somewhere greater than 1 or 2 years of available income in a safe related bucket will insulate you from anything that will be these market swings, because the biggest risk with respect to market swings are in the use of that money. So if you're at a time period where you have to come out of the market to generate income for yourself and it happens to be low, you're going to be thinking to yourself, boy, I don't want to do that, or I feel terrible doing that. It feels like it's an increased risk. So the thing to do is to not have that money there. So we do this already for many of you. You would consider this to be that annuity allocation that sits there safe from market considerations. Those dollars are not going to be affected by the market swings. The worst case scenario for those dollars is that in a particular year, they'll earn zero rather than being negative. That's the goal of that. And it's not with the majority or all of your money, but just a portion of it that we think is going to be needed for you to kind of make those short-term needs, the short-term money. The next thing is actually an opportunity. So I love it when markets are fluctuating and or down, because I like to translate that as stocks being on sale. So now we look at the other side of where your buckets are, and so we start to look at the growth-related bucket. So for those of you that have money that isn't going to be short-term, isn't going to be needed for the income period, but has a long-term view, this is where you might maintain or increase your equity exposure. So I don't know if this translates into our meetings when we talk, but I am particularly risk tolerant. So if it was up to me, you'd all be in 100% equities for anything that you had invested in the market. You don't follow me there, and it's okay. It's fine with that, right? I'm okay with that, because it's not necessary for you to achieve your goals. While it might mathematically make more sense, for all intents and purposes, it's not needed for you to be able to be okay in retirement. So we tailor that to something that is a little bit more tolerated. It's something that's a little bit easier for you to swallow. But if we were in a position that said, boy, this is going to be a volatile period, we would be maintaining or increasing our equity exposure and saying, boy, for money that we don't need in the short term, we're going to follow a long-term strategy and actually increase that equity exposure. But at the same time, what I want to encourage you to do is avoid guessing, second guessing, trying to outguess which of the sectors are going to outperform. So this is one of those things where, based on the news, you might think that that is input to which you should react. In other words, if you see things that are going in a geopolitical area, there are international stocks that are going to be doing one thing or the other, this is not a place for you to try to place a bet. Now, I'm talking to clients that have already given faith over that we're going to be in the right sectors. None of you call me and go, I have a better idea. Would you just shift your money this way? But I want to have this conversation with you because if you see us not reacting to that, that's exactly what we're expecting to have happen. Is that we're not going to make very many changes. We're going to look at where you are invested and remain in the things that are driven by good evidence-based investing. Let me give you a really concrete example. For the last 10 years, domestic stocks have outperformed international stocks. So if you looked at a period from 2025 through 2015 and you measured the two, you would see that US stocks have outperformed international. And so if you were going to be following those types of trends, you'd be like, oh, well, this makes sense. Let me just pile more money into there. But if you measured from 2015 to 2005, what do you think you would see? International has outperformed domestic. Okay, but you said to me, hey, that's not the most recent past. You just had to go 10 more years. I'm just going to take the first 10 years and I'm going to continue with that. Except if you measured from January of this year, essentially the period marking in the new administration through today, you'd find that international has outperformed domestic, okay, by about 10%. What does that mean? We're just going to be everywhere. We can't seem to try to outguess these sectors and what will be overperforming or outperforming. It's folly. So what we're going to do is remain in that same sort of smart, well-diversified, well-established portfolios. And the only thing that I'm encouraging to think about is increasing your equity exposure for that money that you don't need in the short or the near term. Any questions on this before we shift to the next topic? Feeling good so far? Okay. This is supposed to be a nice upbeat presentation. I promise you I'm going to keep it going, feeling good as much as possible. Inflation and the rising cost of living. So for those of you that remember what 2021 and 2022 looked like going into 2023, there were a lot of discussions around inflation. And in fact, inflation was a big topic. It was a big reality. So what was happening is, and this is about a good time for a definition of inflation. Everybody hears it, but I don't know if we all agree on the same definition of what it is. I'll tell you what I have defined it as being. Hopefully it starts to resonate for you. So inflation is what happens when the price of goods increases because of increased demand and low supply. That's what drives the prices up. And so what ends up happening is that we see the cost of goods rising in a way that doesn't match what money people have available. Production's not keeping up, and that's why everything feels more expensive. Normally, inflation is going to look like somewhere between 2 and 3%. There is a normal inflation that exists. It's when it gets to numbers that are abnormal, 7 and 8% we were seeing for quarters during that period, that everyone starts to freak out. As part of the design of your plan, inflation was already built into your income plan. Everything that we designed considered about 3.5% per year, a little bit more than what the average has been, because we like to be on the side of having to apologize that things turned out better than we expected, not worse. So if we can start to put our thumb on the scale of a little bit more conservative expectations for growth, a little bit more aggressive inflation, and the plan works, well, all of a sudden then if those numbers are a little bit better, turns out that it's okay. So depending on what ends up happening, the policy changes that are at least being discussed have a risk of driving inflation up. Okay? So if we end up being in a period of time where we start to see that, what's important is that inflation tends to be a one-way street. The periods of negative inflation are very, very limited historically. All right? They have existed. It's not a zero chance, but normally when things go up, you never see them coming back down. So and lastly, by the way, one of the things that inflation tends to trigger as a regulatory response is interest rate changes. Should I go through why that's the case so that everyone's on the same page, maybe? Okay, so what ends up happening is when inflation goes up, what governments try to do is make money or the access to money more expensive. Because in a period of inflation, everyone has access to a lot of money. It's what's driving the cost. It's that there's not enough goods that are available, which is what makes them expensive. So there are monetary, you can do another thing, which is you can limit the production of goods. That's usually catastrophic. When you're like, you can't make things any longer. When we come in with a regulatory thing, be like, you stop production, and that will then drive, you ramp up production, and that will then lower what the demand looks like. Those kinds of changes are usually catastrophic. So instead what they do is they make monetary changes. They make access to money more expensive. This is something that is problematic when you need to borrow money. So interest rates go up, and when you need access to money, that's problematic. When you're a lender, that is, you're sitting on money and you have it available to invest, higher interest rates are actually beneficial. These are good things. A few people in the room here have already gone through a discussion on refinancing existing annuities that were put in place during lower interest rate environments that are now being refinanced now because interest rates happen to be higher. Before you were a lender lending out money at lower interest rates to the insurance company, now we're offering them to higher rates for higher interest rates. So the fluctuation that comes with inflation makes relying on fixed income products like bonds and CDs difficult as part of your income planning. In other words, there's too much variability. We have never seen, or at least in recent history, we haven't seen the stability of bond payout prices the way it has happened in the past. Usually you could rely on 3.5% in bonds paying out, and you can't design a plan around that any longer. I don't know if you've caught any financial news, but this is one of the discussions that says, is the 60-40 allocation dead? Is that a dead idea? Because previously you would allocate 60% to equities, 40% to bonds, because they used to work in counterbalance. And so you could look at a portfolio like that and expect things to happen. Most of the recent sort of 5 to 10 years examination of that suggests that's no longer the case. We had periods where both stocks and bonds were down. We had low interest rates and we had depressed markets. So how do we design around that? So I just kind of wanted to raise this to be like, well, if interest rate fluctuation is not a reliable thing, what can we do in terms of trying to help protect for it? The first one is one of the benefits of inflation is that the cost of living adjustments that come out for Social Security tend to match what inflation looks like. So those of you that were claiming Social Security between 2022 and 2023, let's see if I can do that without tongue twisting, saw an almost 8% increase in one particular year, and this was after years of like 1.4, 1.9, and so now you can understand how they're related. So one of the things you can sort of anticipate as part of this is that your Social Security should go up if inflation goes up. The other thing is an opportunity to lock in higher rates. So some of you really enjoyed a period of money markets paying out north of 5%, and that was very liquid money. That was very short-term investment. It was a really safe place to go because it was paying a great interest rate, but you can get out of it at any period of time. CDs have started to fall backwards as interest rate cuts have sort of been announced. So beginning in January, we saw interest rates cut by about 0.25%, and then following that, the banks and their issuances changed. Well, the annuity companies end up pricing their things a little bit differently. So all I wanted to do was kind of give you what longer-term fixed annuities, so these aren't fixed indexed annuities, these are like long-term CDs, are currently paying, and you'll see everything is paying over 5%. So one of the things to try to adjust for inflation is to lock in money for a longer period of time, but there are some trade-offs with this. The first is that the majority of the highest numbers here are driven by high bands of money being invested. So I didn't mark out all of these, but this is somewhere going to be between $25,000 and $100,000 going into it in order to secure the highest interest rates. The second thing that's a trade-off is these are not going to be very liquid. So some of these will give you access to the interest as you need. Some of them might give you 5 to 10%. but you're going to look at these as longer term investments. So what you're doing is locking in a higher interest rate for a longer period of time and saying, okay, this is not money that I need right now, but if I was trying to compose a fixed income plus equity portfolio, you're like, okay, I do want something that drives growth for a period of time, like bonds would. You can get something that's got some contractual guarantees on it, even as interest rates fluctuate over that period. And you can see anywhere between 2 and 8 years, they're all paying somewhere around the same, which is about 5%. Okay. Any questions on these? I know sometimes when I put numbers and then products in there, it drives things. You don't have to tell me in the big group here, you don't have to tell me about your individual situation. We can talk about that later. But just conceptually, everyone on board with that? Yeah? Okay. All right, good. The other thing that I'm encouraging to do, and many of you had an opportunity to meet Leslie, who's in the back, who's been having regular meetings with you, is to encourage you to perform what we're calling an inflation audit. So what this looks like is comparing where expenses are and seeing if you have to make any adjustments to your withdrawal strategy. As I mentioned to you, the majority of you that went through this went through a planning process in which we were more generous with what we were expecting with your plan, meaning that we had built in a higher withdrawal schedule, an amount for a longer period of time, which suggests that your plan could withstand some increases. The hardest thing that I have to do with most of you is convince you to actually spend the money that you've got. That's the hardest thing that you get there because you've spent a lifetime being prudent, frugal, right? And this is what got you the balance that you have problems that I can help solve type of situation. But on the back end of that, actually spending this money becomes a barrier often because you've had so much time accumulated not spending this money. I think the saying is don't fly economy so your kids fly first class. Okay, so I'm trying to encourage you to do this, but we want to compare what your actual expenses are to what the withdrawal schedule is and see if we have to make any adjustments. This is sometimes an easier discussion to have with you than spending on a discretionary basis, right? So if I tell you when you go overseas, pay for a guide to be with you the whole time, make it a better experience, you'll be like, no, that's okay, I'll go with the guidebook, I'll walk everywhere myself. And it's like, okay, well, maybe next trip I'll convince you to actually spend some money. This one's a little bit easier for you to spend because these are linked to necessary expenses. In other words, what inflation is driving is the cost of groceries, is the cost of utilities, is the cost of gas, is the cost of everything that it takes to maintain your life. And so what we want to do is make sure you're not going without because you think it's not possible, because you've been living on a fixed amount of money and thinking that that's supposed to remain the same. In fact, it's not. It's supposed to increase over time. So what we want to do is kind of consider an inflation audit to make sure that those two things match. The other thing that's a topic for consideration is inflation. If you have periods that are for a longer period of time, so you're driving what the average is, as I mentioned to you before, doesn't go backwards. It tends to be a one-way street, or we're ratcheting things up higher and higher. So some of you have very strong legacy goals. Many of you, by the way, have great concern for the family that you leave behind. So now what we want to do is make sure that we shouldn't change or attune the plan a little bit differently to make up for anything that looks like increased inflation or cost of living along the way. We want to match what your legacy goal is to the plan that you currently have and make sure that those two things are keyed together. And that might mean, for example, that you're looking at higher increased equity exposure, meaning you're going to invest more aggressively with money that you're not going to need because the time horizon for that is actually the people that you're leaving behind. It's their investment time horizon, not your lifetime retirement horizon. Okay? And then depending on your health, sometimes a life insurance policy will help make that up as well. So I always tiptoe gingerly into the question of life insurance because while it is a great solution for many people, they're not great companies to deal with. You say that you want life insurance and everybody in the office groans just a little bit because of what we have to do to try to make that a possibility. And it's not a you thing, it's a life insurance company thing. Any questions on inflation or cost of living changes before I kind of change topics and go into tax? No? It's a quiet and subdued crowd. Does it take like another 10 minutes before the caffeine kicks in? Okay.
Oh, you do such a great job.
Is that what it is?
Absolutely.
That's what I like to hear, Frank. Flattery will get you everywhere. Tax uncertainty and legislative changes. So it's been well documented that the new administration wants to pay attention to tax law changes. In fact, it was this executive branch that pushed forward the most recent set of tax law changes. And so the Tax Cuts and Jobs Act was what was the Trump tax cuts, but it happened in 2016. They are now set to expire in 2026. So all of the tax rates that were lowered back then, including the individual rates, are set to sunset at the end of 2025. And you're going to go to bed New Year's Eve, and then you wake up New Year's Day in 2026, and all of the changes will go back to pre-2016 numbers. That means that individual rates, on average, are going to increase about 3% across the board. Now, the current administration has been vocal in saying they don't want this to happen. They want to continue those tax law benefits, those lower rates that are in there. And that's also inclusive of beneficial capital gains rates and estate tax thresholds. So one of the things that was set to sunset was not only did we see income tax rates go up, but we saw the estate tax threshold drop back down. Most of you had had no concern with that when I told you it's $14 million a person or $28 million a couple. You're like, I'll tell you when that's a problem. Can you please help make that a problem for me? But for the estate tax rollback, where we might have been closer to $5 million, now all of a sudden that might potentially be an issue. And if it rolled back further, that's where our planning around estate taxes with your revocable living trusts have all built in that contingency. If you happen to be married, you'll be able to double the estate tax exemption. If you're single, you'll be able to use that. This kind of change that's in here is going to introduce both opportunities as well as potential risks down the road. Anything that's going to lower the amount of revenue to the federal government when we don't lower the spending at the same time is going to increase the federal debt. So the way that I think about this is this might be a period of very enjoyable, aggressive tax planning in the near term, with chickens coming home to roost at some point in time, because we're going to have to do something to increase revenue someplace along the way. So what does this look like? Well, one of the first things that we want to be able to do is, and we've been doing this for many of you, is looking at Roth conversions to try to take advantage of lower tax rates. If you've been on this road for a while, you've heard us talk about being more aggressive in these years with the expectation that the tax rates were going to sunset. So we said, we got to do them now, we got to do them 2025, because in 2026, we're going to higher rates. We're probably going to have to hit pause a little bit, or at least slow down the amount of Roth conversions that we're doing. If this administration and those legislative branches extend that, that's good for the planning, because that just keeps taxes on sale for a longer period of time. And so we can now either keep a more aggressive schedule or keep whatever was a less aggressive schedule and try to clean that part of it up so we shift as much over into the Roth bucket as we possibly can. The next thing that we want to think about doing is looking at your allocation of the buckets that you have from a tax standpoint. So I talked about safety, income, and growth before. Now I'm talking about taxable accounts, tax-deferred accounts, and tax-free accounts. So what we want to do is optimize the withdrawal from each of these accounts as we generate income for you. As taxes increase, what we want to do, and by the way, as inflation drives more expensive things, we want to see what we can do to shrink the amount of money that you have in your IRAs or 401ks. If that remains the biggest balance of funds that you have available, then as you need to draw more and more money, you'll be drawing at higher rates especially if taxes in the future increase. So what we want to do is shift that, move that from the tax-deferred bucket into the tax-free bucket, have that grow at 0%. So when we need to take more withdrawals because inflation has increased, we want to be able to take it from that bucket. Okay? This also has an estate planning benefit. And so I think of you all as my primary consideration, and many of you all think about your children or your loved ones as your primary consideration. And we work together to kind of serve both of those goals. I take care of you first. Now if we have something that's extra for the next generation, we start to think about how they're going to receive it, specifically which tax bucket. So we currently have rules in place that if you leave behind a traditional IRA account, doesn't matter if it's invested in the market or in an annuity, that traditional IRA account has to be depleted within 10 years. Okay? That's called the elimination of the stretch out IRA or stretch lifetime IRA. That was all done by the Secure Act in 2020 and refined in 2022. That same rule that says it has to be gone within 10 years actually also applies to the Roth IRA. But there's a big difference about whether or not you have to pull money out of each of those accounts. So with the traditional IRA, if you're over the required minimum distribution age, so I'm kind of covering lots of different people here because some of you needed to take it at 70 and a half, some of you 72, some of you 73. So if you're in that period where you're taking distributions and you leave that IRA to your children, your loved ones, they have to continue taking money out of that. They can't defer it any longer. And in fact, it's almost smart planning for them to continue to take that because if they only take a little bit out for 8 or 9 years and then have to take the balance out in the 10th year, it's going to be a big tax hit to them. When we look at the Roth IRA, that actually has no required beginning date. So the rule is when I leave the Roth to the next generation, I can actually defer that for 10 years with no distribution, continuing to grow at 0%. So this kind of strategic Roth conversion planning is both a benefit for you as you need income in your retirement, as well as for a legacy that you leave behind. Some of you are Pennsylvania residents, and so for Pennsylvania residents, you're going to get taxed on the inheritance you leave to children at 4.5%. It's not the case for the New Jersey people, so you can kind of go like this over your friends in this room now for a period. They're also paying lower income taxes on their retirement, so they do that back to you, okay? So somebody laughs from the grave, somebody laughs now. But that 4.5% is actually applied to the book value, the account statement value, not the post-tax value. So people in Pennsylvania have an additional incentive to convert from a traditional IRA to a Roth IRA because even though they'll still pay the 4.5%, at least they'll pay 4.5% on a real number, not a number that is inflated to something that's pre-tax dollars. So that's an actual tax savings for them as well. The other thing that we want to do is take the period where we actually have lower Medicare premiums and lower IRMAA limitations, those thresholds that govern how much in Medicare we pay, to our advantage. So just as Social Security increases with the cost of living, so does your Medicare premium. So that number that you're paying, which this year might be $184.50 at the lowest number, was just a few years ago $134.50. And so we've seen a nearly 30% increase in a 5-year period of time. You can expect that healthcare costs are going to continue to increase, right? There's no world in which we say healthcare is going to get cheaper as I get older. It's going to get cheaper for the government to run it, right? So from the perspective of looking where that number is going, it's going to comprise a bigger chunk of your income in the future of what it is that you pay. Well, your Medicare premiums, I just tapped that, Katie, and the sound probably went through the roof. Didn't realize I was still wearing the mic. The amount of Medicare premiums that you pay is driven by your modified adjusted gross income. And so I'm going to bring everybody back that I just lost with that. That's everything in income before deductions. It's inclusive of your wages, your IRA distributions, the taxable amount of your Social Security, interest from your any municipal bonds. That's actually included, although it's not taxable for federal purpose. It's actually includable for modified adjusted gross income. So you add all of that up, it's the biggest number of income that you have. That is what determines how much your Medicare premiums are going to be, not this year, not next year, but 2 years from now. So now we start to think about your tax planning from this perspective and go, okay, nobody likes paying taxes. Nobody enjoys hearing that they have a tax bill. But the game isn't lowest amount of taxes this year. The game isn't lowest amount of Medicare premiums this year. The game is lowest amount of taxes, period, at the end of the sentence. And so what we want to think about is what your lifetime taxes are going to look like. And for those of you that have loved ones that you're concerned about, their tax bill as well. I want the lowest amount of taxes to come out. And if we're doing that kind of planning a little bit more aggressively in nearer terms, 2-3 years worth of it, then what we're doing is we're locking in what your Medicare premiums are going to be, because while they might be high for those 2 periods, as soon as I'm done with those conversions, they're going to drop to the lowest level. And even as though that's going to increase, it's not going to be as expensive as if I kept your income high all of those years and you were in that 2nd or 3rd tier for Medicare premiums. Is that making sense for everybody? That what we're doing is trying to plan for a little bit more pain today, for less pain overall, less pain in the future when incomes are going up, and also when Medicare premiums are going up. Okay? Oh, I'm sorry, I didn't complete the end of the sentence there. Distributions from Roth IRAs do not count against your Medicare premiums. That's why we're doing this as a strategy. So I said it's all of those sources. There are 2 sources that don't contribute to it. One is withdrawals from cash value life insurance. There's 3 actually. The second is withdrawals from any health savings accounts, but most of you don't have any and you're done working, so you're not going to contribute to any new ones. And then the last one is Roth IRA distributions. Those 3 sources are what I define as being truly tax-free. Tax-free from federal taxes. Social Security doesn't drive how much of your Social Security is taxable. Same thing with respect to your Medicare premiums. Okay, the next one's with respect to Social Security. It's an interesting world to live in right now. I've met some new prospective clients that I've been having meetings with, and maybe for the first time in a decade, I have people asking me to design income plans as though Social Security doesn't exist. And it's not something that I have traditionally done. I've said, look, they're going to change some of the rules, but I don't see it as going away entirely. And yet I've got prospective clients going, yeah, but show me that picture anyway. Of course we do. Well, the changes that I expect to happen are the same changes that we've seen historically. I don't think, or I'm at least not advocating that you plan around different kinds of changes because of the specific administration that's in place. Here's the way that they make changes in order to continue this going. 1, they defer the age by which you can begin drawing benefits. They make it older and older. So sometimes what that means is planning is that you elect your benefits sooner so that you're not captured by anything that kicks the can down the road. The second thing that they do is that they increase, it's going to be really complicated, they increase the calculation for what it takes to get to the highest amount. So the way that this works is every year that you earn income, you're earning against a top number of whatever the maximum contributions are. Some of you know this when you're working and they stop taking your Social Security out of your check. It goes up for the last few paychecks. That's because you contributed to the max there. You hit the top number. What they're doing is they are essentially tracking the number of years. I'll just use the top number as an easy way of explaining, but like how many years did you hit the top number? If you hit the top number for the right number of years, then you get the top amount of Social Security that's being paid that year and continuing it on for the rest of your benefit years. And of course, it's a little bit more granulated than that because you have years where you didn't make as much, and so that's how you get the variability of what your potential Social Security award is. That's the first thing, is that we're going to see changes to people either when the ages that they can claim or what would qualify for being the top amount that's in there. And then this other thing that's in there, which I've already touched upon, is the Medicare premium sort of increasing along the way. We've already got a good history of seeing this increase over the last 5 years. I expect that it's going to continue to increase at a rate. Look, every time that they increase Social Security, they increase Medicare premiums, and the net to your pocket is a much smaller amount. So you watch them move kind of in lockstep, that if one went up by 8%, the other one went up by 8%, and all of a sudden you kind of have the same dollars that are in your pocket. So if we have both of these ideas in mind, the first is for those of you that have not already claimed Social Security, starting to think about a claiming strategy that not only optimizes when you can do it from a financing standpoint, like how much money will you be getting, but actually maybe claims it a little bit earlier so that you can lock in the benefit and your rights to the claim as opposed to deferring it. And we've got to help you work with those calculations, because for those of you that haven't claimed it yet, many times you're following our recommendation to try to defer at least one person in a married couple to the maximum amount so that you're locking in the highest amount after one spouse dies. So you're trying to increase that fixed income off of it. So that might have to get revisited in order to lock in the benefit, and then we've got to kind of help you calculate what the impact to that is. How stable does it make the rest of your planning? Okay? But for those of you that are already claiming, strategies to reduce your modified adjusted gross income on 2 different periods are recommendations. So I've already talked to you about the long period, making Roth conversions so we have stuff that's lower. The other thing that we're going to take a look at is it may be time to shift some of the investments away from things that are paying off dividends on a regular basis that are uncontrolled to sort of tax managed accounts that retain those dividends. So you'll have a total return of growth that's still there, but you're not kicking off money that is taxable and driving you into higher numbers. Does that make sense for everybody about an investment strategy? Like, you know that if you've got things that are coming in or that are interest and dividends, you can't always control how much of that is going to be kicked off and therefore included in your taxes. This is why you all are hungry for 1099s to come in January and then February, and then the corrected one comes later in February, and then you're frustrated because you filed your taxes already, then you got to file the amendment to it. This is because that all of those corrected dividend disclosures or whatever's going in there were not things that were settled. Many of them kicked off dividends, let's say December 15th, right? Or realized capital gains inside of funds. So you have options to shift some of those investments to things that are tax managed, meaning that they retain those earnings and don't realize them. And so while that means lower sort of interest or dividend incomes that's being thrown off to you in that particular year, it's also a lower tax bill. And so that's something that you can do in the short term in terms of being able to manage this. And when we do tax projections for anything, like we're going to do Roth conversions for you, or we talk about how much to withdraw from certain accounts, we're looking at your IRMA or your Medicare number for this year with 2 expectations. The first is that the IRMA that will be applied 2 years from now will be higher. That's the first thing that we're expecting, that there actually will be increases. So we figure if we keep you below that for this year, there's a great chance that you'll actually be below that in the future. And the second thing that we're doing is probably to keep a number, maybe usually 1,000 or 2,000 of buffer room, especially if we're going to be making Roth conversion recommendations in September, October, and November, not knowing what December's dividends are going to look like. We want to build some buffer in that as well. And so many of you went through that dance with Jake and Leslie this year as you went through making sure your RMDs were taken and any Roth conversions were done. Okay. The other thing that we would make recommendations for, again, if you still have a health savings account to fund healthcare, great. but always be reviewing what your Medicare supplements are. Just because you've had one for a long period of time doesn't mean that you have to stick with that particular plan. Same thing with respect to anything that is your prescription plan, your Part D plan. So both the supplement and the Part D plan should be up for regular review. And if you haven't had a chance to talk with our partner Carol Baker before on this is a great opportunity to meet somebody that is not in our office, somebody that we're connected with, but somebody that we feel very confident in doing Medicare. It's a whole specialized area. In fact, Carol is the firm's healthcare broker, so she's the one that provides our health insurance to our team here, but also is our conduit back out for any clients that have got questions about Medicare supplements and going through that election process. Okay, so if you've got that need, reach out to us for that. Okay. And then the last area is longevity, long-term care planning. So one of the things that I made my I don't know, maybe reputation for a long period of time on was doing asset protection planning for folks that either it was them or their parents and they wanted to make sure that they were securing health care benefits, specifically long-term care benefits. So depending on the client, that was either benefits for veterans, or they were benefits using Medicaid off of it. So what I anticipate, one of the risks here is the changing landscape to what the value of what those benefits are. We're in fact even seeing the rollout of this is either different states or at a federal level, money is either being withheld or changing what the landscape of these entitlement programs look like. What does that mean from a planning perspective? Well, as confident as I may have been in the past about getting people to use irrevocable trust to be able to qualify for Medicaid, I'm not sure Medicaid's going to be the benefit that it once was. And so looking at the amount of money that's going to be available, paid out as a Medicaid number to facilities, may not cover great facilities for you. It may not cover a welcome facility placement if that's the source of pay. And then the other thing that comes in, which is they're lengthening life expectancy. I don't want anybody here to die sooner than you want to die. But traditionally, the longer life expectancy comes at a more expensive amount of money at that period. In other words, very few people take their life expectancy, their lifespan, and also increase their health span so everyone just dies. They're feeling great and they just kick over, right? So there's usually a long tail off of that. And so what we want to do is look at those two things. This is not a policy-driven administration point. This is to be read with that. And so look at a couple of different things for solutions for this. The first one is to consider hybrid, or what we consider to be cash value long-term care policies. Now, this is a great choice with us in terms of the way that we think about it, because these solutions cover a couple of risks that we don't like about traditional long-term care. The first is that as a cash value policy, you're never at risk to losing the money that you've contributed there, at least not all of it. Traditional long-term care will have you paying a premium every year, and then the company can increase it. But the moment you stop paying, the policy and the coverage goes away. I don't like that risk very much. We've written almost none of that in my career for people, because what's happening is as the need for care increases, so does the cost. And then you've got clients trying to figure out, can they still match it in their budget should they continue it? What we like better is to carve out a portion of whatever is your investable net worth and see if that's appropriate to put into a long-term care policy. Now let me walk you through what that analysis looks like internally, because there are about 3 different things that we're considering. The first is your personal circumstances. So some of you are either health prohibited or age prohibited from this even being an option. And so if that ends up being the case, it was a nice idea, but we move on to something else. For example, the ones that are driven around life insurance are health underwriting qualified. The ones that have annuity benefits, where you just buy an annuity and you have an increased amount of income if you get sick, are not health driven. So this is where we start to go through our decision tree to say, okay, which one's available? The second component is, do you have the investable net worth to allocate money here? And in this thought process, I'm going through trying to figure out, well, are you okay with your safety bucket? Are you okay with your income bucket? And assuming that that's the case, because I know that you're going to retire, I know you're going to need income in retirement, I don't know that you're going to get sick. So in a hierarchy of priorities, long-term care comes underneath providing income for you. Assuming that we have those two things met and you don't have a legacy goal, something along the lines of leaving money behind for the next generation, where we have to allocate that money to something else, now we can start to look and say, all right, if we put this to work for you in a different fashion, does this make sense? Does it make sense for the rest of your plan? In my experience, we've never grown to more than 12%, but it's usually between 8 and 12% of your investable net worth. If we can carve that out, put that to work, if you don't need that in the short term, it seems to make sense. The third thing that we're going to take a look at here is in the design of this particular solution, do we want any of this money back in our lifetime? So this is what's called a return of premium. So the way that these end up working is we allocate it to the long-term care policy. Great, it's there. If you die never using it, it's left behind as a death benefit. And if you happen to spend through all of your money and you need it back in order to continue to live, it gives you an opportunity to get most of it back. Sometimes it's 80%, sometimes it's 100%, but I didn't throw money off of a cliff. You have to kind of jump through all of those hoops for this thing to become appropriate, right? You need to be health eligible. It needs to fit into part of your plan. You need to be able to slough this off to sometime in the future. And then it's a really good solution if you happen to need long-term care in that beginning 10 years of the policy, let's say, right? Because if you just invested it for 15 years, you might get the same amount of money available to you, but we don't know when you're going to get sick. So we kind of see if that's an option along the way. These are helpful for the people that are in there, and they kind of work together with the long-term care asset protection planning. So a lot of you have these IRAs or even Roth IRAs that we've converted for you. We're not going to put those inside of the irrevocable trust, even if we wanted to use one for you. So if we're not going to do it early, maybe we create the irrevocable trust, maybe owns the home, maybe we get the long-term care policy that gives us 5 years worth of coverage. So if you happen to get sick, that's the point in time where we'll get more aggressive about either depleting an IRA account or depleting a Roth account and put it inside of a trust. But we won't cause either to cause too many taxes or lose the 0% growth if we don't know that you're sick. So sometimes you kind of work them together. This one I say gingerly, because I don't know what your family situations are all like, and whether or not you want to buy a house with your kid that's got an in-law suite and go, this is my solution, somewhere that's going to look like managed care, because the biggest issue is about where you're going to get the care provided, who's going to provide that care. So different situations are in place where you may not be able to rely on family, or either the people are unreliable for whatever reason, or they're far away. And so this may not be an option for folks, but I remember that when I redid my house in Pennington, I told the architect, listen, my wife and I are the oldest in our family and the most well-established. So it's likely that one out of our 6 parents, my parents divorced and remarried, one out of our 6 parents is going to come and live with us at some point in time. So the architect came back and I bought a house that was run by a doctor, and he had his office on one side of it. So he redid that whole area, and there was like a room, kind of looked like a living room, another room, kind of looked like a kitchen, and then a bedroom and a bath. And then if you walked out of here, there was like our main kitchen. So I pointed at that, and I said, what is that? He goes, oh, they call it an in-law suite. It's in there for you to live in there. I said, you don't know Puerto Rican families. I could build that kitchen, and that parent is coming into my kitchen in their pajamas, and it's never getting used. So that's going to be Dad's office. Like, we're just going to take that back from there. So you don't know exactly what the family situation is going to look like in terms of additional support, but definitely making sure that those people that you've nominated to be healthcare agents, specifically for those of you that are married, the children, those of you single may have already done this, and getting them in line with what your healthcare choices are. Most people meet expectations that are spoken. It's the unspoken expectations that give us the mixed result. So this is a time to kind of talk with those people and be like, this is sort of what the plan looks like. You don't have to give them numbers. This is my expectation of the kind of care that I want provided. I'm comfortable depleting my money in my own care. I've given enough to the kids. If there's anything left over to bury me, that's fine. But other than that, I'm not looking to save a bunch, or the other way around. This is what I would expect for care. These are what my plans are. But you really want to have these communications is if we can't rely on what Medicaid's going to look like. And then the last component of it is that looking at annuities as inflation-hedged income is a good strategy for many people. And so what we're thinking about here is if you were to take money, let's call it $200,000 for sake of discussion, and I was to take out 5 or 6% of that per year and give it to you and essentially continue to invest it, at some point in time I'm going to deplete it. If I'm keeping that income static the whole time, I'm not using it as a percentage of the balance, but I'm using it as a static amount, at some point in time I'm going to run out of money. What I can do is actually shift that to an insurance company and say, look, I want you to pay me out 8% of this, and then when it's done being paid out as a cash value, I want you to keep giving me a check. And they say, okay, we'll do that for you. But there are two sort of trade-offs in it. The first trade-off is it's not going to match market returns. This is purely an income play. We expect to consume the entire value of that and not leave anything behind. Okay? So we didn't make it grow. Don't think that it's going to grow greater than the market. It's just going to pay out something that's going to hedge against a longevity risk, because once I'm done paying out money in there, it just keeps paying. And for married couple, until the second person has passed away. There's no risk, by the way, if you die early that you don't get that money back. There's always so if you get paid $10,000 out of the 200, 190 is going to go to your kids as a death benefit. So there's no risk that in buying it that there's no money going to come back. But the second component of that is that it's not going to be inflation adjusted. So when I get that income coming in, it will give me a floor that will last forever, but very few of those companies have an increasing benefit off of it. They usually are going to hold something flat. So those are my trade-offs. My trade-offs are that I'm not going to be matching pace with inflation, and I'm not going to be matching pace on what I'm going to need to leave behind for the next generation, but I am going to get guaranteed income. When you match that kind of strategy with the other thing that I talked about, which is increasing your equity exposure, all of a sudden the plan mathematics makes sense. Because if you stabilize the income, you can take a more aggressive investment strategy because you're not looking at the more aggressive strategy as the source of at least most of the income. It might be a portion of it, but you can ride much more volatility. It's kind of marrying those two things together, and it's a way of kind of leveling out what that payment's going to be and stabilizing the volatility withdrawals while also meeting a longevity risk that says, if you happen to live longer than expected, can we still get money to be coming out on a regular basis? And these products do that. Okay? Some of you already have them in place. Some of you have them in place, haven't turned them on yet. Some of them don't have them in place. But this is an opportunity to kind of think about this and say, okay, if I'm now concerned with what long-term care might cost in the future, having guaranteed source, I like to think about as bringing your foot off the accelerator. So you're just not spending your own money, but I have something that's coming in and driving some guaranteed income, and then it's your responsibility to come up with the difference. Well, I made it with 1 minute and 15 seconds left to spare from when I began. Any questions about anything that we've discussed today, beyond anything that we've discussed? As long as we respect that we're not going to have a politics discussion, I'm willing to entertain anything that you've heard as news that you want to hear an opinion on.
The 10-year thing.
The 10-year thing for the inheritance of IRAs. That one?
Oh, yeah, I understand.
Yeah.
Okay. You want to go through it again?
That's for our kids to worry about. We don't have to worry about.
I don't want to leave them anything.
Okay. That solves that.
There is a book that was published about 6 years ago, I think. It's called Die with Zero. And it was there was a discussion amongst advisors online.
Clarify that.
And grandchildren. So the book came out, and there was this discussion online by advisors because advisors We like to argue when we're on the internet. Everybody likes to argue. But this particular one was talking about whether it was ethical to plan for someone to have zero money at the end. And so they were all wrapped around the axle about whether or not it made sense in Monte Carlo. I was like, you all didn't read the book. Because the book, Die with Zero, was not about spending all of your money. It was about understanding that there are categories of wealth that you own. And for many people, categories of wealth that they don't pay attention to as much as money include the time that they have, the health that they have, the experiences that they've acquired. And what the book talked about is matching or paying as much attention to your increase in wealth in those areas as you do to your monetary wealth. And so what ends up happening is people tend to mismatch the availability of their funds with the availability of their health and opportunity to have experiences. So I joke about this when people talk to me, and I say, well, listen, your skydiving money was before. Like, you have a lot of money right now, but the coupon's expired for spending that. And so some of you are now looking at it and be like, okay, what about my walking the cobblestone streets of a European city? So that's coming up due. So why don't we spend that money now when it's appropriate so that we can increase the wealth of experiences? Because if we keep saving that for later, you're going to run out of the time and the health in order to get what the value of that is supposed to be. So that was the Die with Zero discussion. It wasn't to make sure that there was zero account. Although if you want to find a place for it, my children are still yet to go to college all the way. So I'm fine if you want to contribute it to the Medina Fund. Any other questions? Yeah, go ahead, Rick.
So there was a proposal floated for making Roth conversions totally tax-free. Any thoughts on, you think that's going to move forward or not?
No, I don't have thoughts except to offer it I think is extremely unlikely. They already made changes. So, during a period in which, so let's just break out the discussion and line people up. We're going to find opportunities with liberal-driven agendas and conservative agendas to be in kind of an opposition, right? And so one of the things that happened when there was a conservative legislative body was to pass the Secure Act, which drove faster the realization of income, taxes and income that were in the IRAs. That's kind of what was there already. Those were the people in charge. I find it very hard to believe that those same people are now going to limit how much revenue is coming from there and offer a plan that doesn't make that revenue available to them. So they did that two ways. They did that by, this one's actually sneaky. They did it two ways. One of them was to make the lifetime IRA go away. So they accelerated to the 10-year schedule. But the one that you had to pay attention to the math that did it was actually the extension of time to begin your RMDs. So by driving that up 2 years, actually what happens is if those accounts grow on an average of 4.5%, you're actually getting, the federal government's actually getting more money by the deferral because you pay taxes, your RMDs are a percentage of the balance, not a flat number. So they actually accelerated revenue from those accounts when they were in charge before, and so it doesn't seem to me to be realistic or consistent that they would all of a sudden reverse course and make that happen. But geez, if it does, our calendar is going to be filled with making sure that all happens while the door is open for it. Yeah. Great. Other questions?
Yeah, how
Tom.
do you feel about Bitcoin?
Yeah? Were you trying to poke the ferret while I'm in here? So I have a well-principled response for that rather than an emotional response to that. Because it would be an option, right? If you wanted to give me money to manage, could we put it into Bitcoin? We could, right? So what we're looking at any investment is two things. Does it have a higher expected return than an alternative? And does it have a higher expected return given its volatility? So it's basically what we look at. It's like if we could expect that it's going to grow, let's say at 8%, is that higher than other things that we could be invested in? And then is it higher than something that either is lower than that volatility or is more stable on that volatility? So right now, it is the equivalent to other currency plays. Right? So you'd go in and be like, okay, I have a higher expected return if I can trade currencies. It's in that same realm off of it. but no higher in what that return is than what I could be doing if I was in emerging markets, or if I was in real estate, or if I was globally diversified. So we start to look at that and say, right now there's not enough evidence for us to shift that money because I'm not getting more return on it on any expected basis, and I'm not lowering the volatility for any particular thing. I'm narrowing the scope of what the volatility is because most of these, you can get some that are diversified funds, but most of them you're actually making, you said Bitcoin, but I'm understanding that's crypto in general. And so you can get a little bit of diversification, but how much diversification can you get when there's only 3 or 4 major players of what cryptocurrency are? We've narrowed that. That's like betting on one particular currency or 3 kinds of currency rather than saying, I think that equities work. Now there's 2,700 equities, and now I'm just going to figure out if I'm going to be in small cap or large cap relative to what I would expect. So that's why while everything's available for analysis, for consideration, it's sort of like it's a value neutral. That's why we think all tools are worthy of consideration. Some of these tools fall into a category of like not recommended right now because they don't have any principled reason why to make shifts into them. That for me is there. It's in collectibles. It's in variable annuities. It's in these categories of things. It's like there's really not a strong preference for one over the other for what we could get with stuff that's got evidence behind it. And if it shifts, we're up to it. I'll tell you where it has changed in the last 15 years. Last 15 years, we had no reason, before 15 years ago, we had no reason to invest in profitable companies to the sort of with a more higher frequency than unprofitable companies. Back 15 years ago, you would look at both of those numbers and go, it's about the same. And about 15 years ago, the analysis said, actually what we ought to do is invest in profitable companies because we can have a higher expected return. It's a dimension of return that will have a higher expected return than not. So we started to tilt to that, and some of you that will look at your portfolios will see high profitability, and you'll see that as one of the name of the funds that's in Schwab because there's evidence to support why we're there. So there's lots of stuff that's still always under consideration. It's just when it meets the test, then it's worthy for discussion, and right now, nothing in crypto would be. All right, any other questions from anybody else? Okay, well listen, thank you so much for coming. We're recording it, and one of the things we'll make available to you is a link to the recording. So if you want to come back and revisit again, don't feel like you had to take notes just in this session. You can kind of play it again. I'll have a handout for everybody in here. It just takes the 5 areas that are discussed in here and just gives you the risk, the opportunities, and what the different solution options are. Okay? And I'll stick around for a little bit.